Since 1972, the McIlvaney Financial Group has been a conservative, contrarian investment firm. With that mindset, they have created a multifaceted approach to portfolio management, offering a wide array of services including wealth management, a unique short fund, hedging through precious metals, and excellent educational resources. We have had David McIlvaney on our show multiple times because we respect his outlook, viewpoints, and recommendations. You really need to let them give you a much better understanding of what true portfolio diversification is. Just go to mcilvaney.com/Main Street, with Main Street all spelled out, to get introduced and to garner free information. Again, that's mcilvaney.com/Main Street to schedule your free 20-minute consulting session. Hi, everyone. This is Jason Barrick of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is CEO and founding partner at 720 Global. He's a chartered financial analyst, or CFA, and he has more than 25 years of financial market and risk management experience. And his articles have also been featured on Zero Hedge. Michael Lebowitz, thank you for joining me again.
Thank you for having me again, Jason. Appreciate it.
Now, Michael, before we cover some of the global macro topics that I know you put out articles on, you have a new paid newsletter out as well. I'll let you talk about that later in the interview. Let's talk about the Federal Reserve first. So the Federal Reserve hiked rates again, another quarter point in June. I think they're up 1% total. Do you think the Fed is done hiking rates?
I think this is actually a really interesting question because I think the Fed really wants to hike rates more. Now, the market is starting to quickly come to the conclusion that maybe there's one more rate hike, but it's over the next 6 to 9 months. But based on everything that Janet Yellen and Dudley and Fisher are saying, I get the impression they would love to do a couple more, maybe even 3 more by March of next year. So I think, they're very sensitive to the market, but they also, based on some comments, they feel the market's a little overvalued. As we'll probably talk later, I'm going to argue that it's very overvalued. But nonetheless, I feel like they have some room to take a little steam out of the market bubble, little air out of the bubble, and raise rates. And, the question is why. The economy is clearly stagnating. It's growing sub 2%. It's not clear where economic growth will come from in the future either. And I think what this stems from is their desire that when the economy does turn into recession, which it inevitably will, they want the ability to lower rates before they have to go back to QE. It gives them a tool, may not be a great tool, but a tool before they have to use that, what's been described as the nuclear weapon.
Yeah, I was going to ask you why you think that they're raising rates, because they're talking about the jobs market and how well it's doing. But if you go back and look at all the Federal Reserve speeches after the 2008 financial crisis, from Ben Bernanke, from other Federal Reserve Board governors, from the mainstream financial media, the Bureau of Labor Statistics, they were talking up, since 2008, all the retail and restaurant jobs were created. But Michael, it looks like, the last 12 to 18 months that there's been nothing but job destruction from restaurant and retail.
Right. It's been, the job numbers on the face of it look really good. The unemployment rate's low. The unemployment claims numbers are incredibly low. But the breadth of the market, of the job market, is not good. Hours worked, wages are not what you would expect, given an unemployment rate of, what is it, about 4.5 now? And given a jobless claims number that's one of the lowest in history. So there's clearly, yes, the headline numbers are good, but the quality and how long people are staying with the jobs, how many jobs people are working, how much they're making, is not on par with those headline numbers.
Exactly. And it looks like part-time jobs, and there's been over 1,900 retail store closings already this year. The restaurant number, I don't know if anyone's actually keeping track of an accurate number of restaurant closings. You and me, Michael, we live in very nice, affluent counties here outside of Washington, D.C., 3 of the 5 richest counties in the entire country. And yet, all around me, Michael, I don't know about your area in Maryland, but I see tons and tons of restaurant closures all the time now.
Oh, I do too. It's I'm here in Bethesda, Maryland, which is actually doing economically really well. and there must be a quarter to a third of the stores are vacant, and these restaurants come and go.
Yeah, and this is a big divergence then from the story that the headline numbers are telling us, because if the economy was really doing so good, Michael, people would have discretionary income and they would be eating at these restaurants, and we wouldn't be seeing them going out of business as quickly as we are seeing them.
Right, and I agree with you. I think that business in particular is an economic signal. So it's very interesting. I think the economic data to some degree is failing the Fed too. I think they're stuck with their old models and old patterns, and they're not willing to consider that the economic data may not be nearly as good as they think it is. I think there's some of the issue stems from the widening wealth gap. So those that have money may be spending it, but there's more and more that don't have it, and they're not spending it. So the economy may be good for the upper 5–10%, but those that it's not good for, it's really not good for. And I think when you start digging underneath numbers, that's what you start finding out.
Those are great points. So if you own the assets, you own the real estate, either residential or commercial, you own bonds, or you own a good amount of stocks, not gold stocks, but if you own regular stocks, since the 2008 financial crisis and the Fed and other central banks started reflating things, you've done very, very well for yourself and your net worth on paper with this asset price inflation.
Right. So that's I recently wrote an article on this called "The Fed Giveth," and I started the article off explaining why QE did not cause inflation, and that what I just said there was wrong, because the Fed did cause inflation. They just didn't cause inflation in the things we buy every day: food, gas, you name it, the stuff that we spend our cash on and we charge on our credit cards. The way that they directed QE towards the financial markets allowed for the price of financial assets to inflate, and they inflated quite rapidly. So in that article, I say, well, what if instead of doing QE the way they did that, what if instead they would have done it towards infrastructure projects? So they would have figured out a way to print money and I get, not quite legal, but promote infrastructure projects. Well, construction workers' wages would have gone up. The prices of machinery would have gone up. The prices of materials that are used for those type of projects would go up. So the inflation will show up where they push the money. And I jokingly said, what would happen if you were going to give 8-year-old girls $20,000 each? What if that was your QE program? Well, the inflation would show up in Barbie dolls and other things that 8-year-old girls buy.
And candy, yeah. And chocolate, yeah.
Chocolate. That's exactly right. And they directed it, towards financial assets. And Yellen and most others have been very clear about the wealth effect, and that they believe the wealth effect works. In other words, you richen the few at the top, the ones that own the stocks and bonds and all these financial assets, and then they spend their money. But if that sounds good in theory, but it doesn't trickle down. And if you kind of take it to the extreme level, let's look at Bill Gates, who has billions and billions of dollars. Nothing, even if he makes $100 million today because his stocks went up, he's not going to spend any more. His marginal, he has what he needs. His marginal desire to spend is minimal, and it's not really affected by the Fed at all. So those that are rich are getting richer, but they're largely at this point they've either spent it on some of those things they've always wanted, or there's not that much spending and not much trickle down coming out of them. So again, it's another flawed theory that the Federal Reserve is pushing.
Yeah, more misallocation of capital with unintended consequences. I want to ask you now about the Federal Reserve's balance sheet, in coordination with potentially raising interest rates more. I don't know if they're going to be able to raise interest rates more. If asset prices fall, they probably won't want to raise interest rates more. But if do you think the Federal Reserve can meaningfully reduce their approximately $4.4 trillion balance sheet?
So I have a graph in that article that shows the rise of the stock market with the increase in QE. And prior to Trump being elected, it was, I forgot the number, but something like more than 95% of the gains came during periods of QE. So let's work that in reverse. And I end that article with what the Fed giveth, the Fed taketh away. So if the Fed starts removing that liquidity, what's going to happen to the markets? And that's, I think, where the rubber hits the road, where they start pulling away liquidity, bond yields could start rising, and I think money will start coming out of the stock market. So I don't know what the level is. Maybe they can remove $5, maybe they can remove $1 trillion, but my guess is somewhere in the early stages of normalizing our balance sheet, things get rough quickly for asset prices. Not necessarily the economy, because the economy didn't really benefit from QE, but asset prices.
Yeah, I mean, the economy could get worse, though, if asset prices go down, because look what happened in 2008. So, I mean, like, the asset prices collapsed, and then companies were started cutting back on jobs as well. But what do you think about the theory that, I know you're friends with Danielle DiMartino Booth, and you read her book before it came out. What do you think about her theory now that a lot of the Federal Reserve members are hardcore Democrats, and now that, you know, their favored candidate, Hillary Clinton, didn't win the presidential election, Trump won, now they're more welcome to raising interest rates and crashing the asset markets intentionally to, you know, limit Trump to one term? What do you think about that theory that Danielle DiMartino Booth has put out there in public?
I'm not sure I would support that fully. I mean, we know Yellen is a Democrat. I can't speak for the rest of them. I would bet Dudley actually is Republican. But I think it's irrelevant. I think what matters, I don't think that Yellen and probably the others feel the need to support Trump. So what I'm saying is I'm not sure they'll let him bully them around if need be. So it gets interesting if, let's just say, the Fed raises again when the market's not expecting it, and then the Fed also announces that they're going to start normalizing their balance sheet come October, and the market's down 10, 20%. Well, remember, we have a president that said that the stock market is his mark to market. So with the stock market's going up, in his mind, he's doing a good job, and if it's going down, he must be doing a bad job, which I think is one of the more ridiculous things I've ever heard. But nonetheless, that's kind of what he has said numerous occasions, and Gary Cohn has also mentioned it as well. So we get in a predicament where the market's down 20, 25% because of actions of the Fed. And Trump is leaning hard on the Fed to become much more dovish, to lower rates, to stop talking about normalizing the balance sheet. I don't think that Yellen will acquiesce.
And Trump is also saying, to add to your points there, Trump is also saying the dollar is too strong already. So he's actually publicly made those comments. I think he was the first president to actually publicly make those comments to try to talk the dollar down.
Right. You know, I mean, this all comes down to the same thing. The real way to build an economy is through investment into new means of production, into supply chains, and what results in productivity. They're all trying to cheat the system. Trump's trying to cheat it with, you know, like you just said, a weaker dollar so we can export stuff. Yellen and the Fed are trying to cheat it with lower interest rates. But at the end of the day, if all the parties involved, both sides of the aisle, and I think they're both equally guilty, would focus on investment and education and things that help increase productivity, I think the pain up front could be short, but the benefits in the long run can really be much better, as opposed to having to constantly cheat future growth to get some semblance of current growth.
And Trump's also talked about, you know, putting on value-added taxes on imports. So, you know, those tariffs could create a trade war down the line. So hopefully he doesn't act like Herbert Hoover did and other past presidents and create, you know, make it more easy for an even bigger trade war in the future. But, you know, Janet Yellen, Michael, I think can leave in February. So I think, you know, I watched her last press conference when she did the rate hike in June, her answering the reporters' questions. It seems to me she already has one foot out the door. Like, I think, you know, she doesn't want the markets necessarily crashing before she leaves, but she also doesn't want to be the bag holder when we do have the next major global financial crisis. So I think she'll be back. I think she'll leave probably the Federal Reserve in February when her term expires. She won't ask for a renewal. And then her and her Nobel Prize winning PhD economist husband can take their 3 or 4 pensions and they can go live very, very comfortably.
I would not disagree with that. I mean, I don't think that Trump keeps her on board anyway. So I think that come, what is it, February, March 2018, in another 6, 9 months, there will be a change at the Fed. One of the disturbing things is that President Trump has put forth Marvin Goodfriend to fill one of the open positions on the Fed Board of Governors. And I've read not a lot on him, but he is very well. He's not a big fan of QE, which is good, but he is very willing to embrace deeply negative interest rates. So I'm not talking about deeply negative like Europe, which is -0.5, -0.25, minus even 1%. These sound like deeply negative, -3, 4, 5, 6%.
So charging people 3, 4, 5% at their bank account to force them to spend the money.
Yes, but what's interesting is the problem with that is, well, no one's going to keep their money in a bank, right? You'll put it under your mattress at some point.
Or Bitcoin or gold. Yeah, it's good. Right. Bitcoin price, the cryptocurrencies, gold, silver, they're going to go through the roof then.
Or any asset, right? It doesn't matter. Everyone has their own preference. It could be cows, it could be houses, it could be you name it, but it doesn't matter. That defeats their purpose because they need to be able to affect the economy in their own heads. They need money in the banking system. So one of the things he's talked about, and I wish I had this article in front of me, it was in the Financial Times, is embracing, and I got to be honest, I completely don't understand it, but a floating rate currency system within our currency. So not floating compared to the euro or the yen or the pound, but the value of the dollar is not always a dollar, so to speak.
Welcome to dystopia. That would confuse even sophisticated financial professionals. Sounds something like a bunch of PhD Keynesian economists in a classroom were discussing where we can just automatically put interest rates at -5 and it'll force everyone to spend and the money will go wherever we want. It sounds like this total theoretical experiment.
Right. And I was actually, you'll like this story. I was at the little dog park right around here, and one of my neighbors works for either the IMF or the World Bank. I forgot which one. And I said, "Do me a favor, read this article." It was a relatively short article, and I go, "Explain it to me." And he's a PhD economist, and I believe he's pretty much Keynesian in his attitude, and for that reason, I normally don't bring up economic stuff because there's no upside. But I just said, "Just explain it to me." So he read it, and he starts talking, and then he goes, "Let me read that again." He read it again, and I think he was as stunned as I. He couldn't. He kind of got around to an explanation. It was kind of the same explanation I kind of figured out, but it was just outright scary.
I think the solutions, and I use solutions, I have air quotes right now. It's like those doctors in the 14th or 15th century where, they bled you with leeches, where the cure is becoming worse than the disease now. So any solutions to the global financial crisis are just going to, make things even worse in unexpected ways.
Well, you have a choice. You can either keep kicking the can, which by every measure, both political and Federal Reserve and even corporations, that's what they're trying to do, or you can address the problems. The problem with addressing the problems is that it's going to be very painful because you said it earlier, we have misallocated so much capital, and there are so many companies that may seem okay now, but in reality they're zombie companies that need to go out of business, that people they're going to need to be fired, but ultimately relocated to areas of new growth that can be promoted. And that is something no one wants, but the question is, are we looking out for the next 5 or 10 years or looking out for the next 15 minutes? And that's something that people need to understand, and we need to decide on. But every day that we decide to kick that can just makes the future that valley between the two that much steeper.
Yeah, Michael. And one of the areas where there's an enormous amount of misallocation of capital is in the stock market. It's from large corporations in the Dow and the S&P 500. It's in share buybacks. And that's misled a lot of investors. People are chasing yield for dividend income because the Federal Reserve has and other central banks have had financial repression for years. So people who needed income for retirement, I guess they, with their stockbroker, they went in to look for stocks. And, now the stock market, to me, Michael, I think it's one of the four most overvalued stock markets in history. There's a good argument to be made. It's up there with 1929, 1999, and 2007.
I would just say it's on par with 1929. It's well surpassed 2008, 2007, and it's only been elapsed by 1999. Now, what's interesting is I did a study on this. When you look at the economy in the 90s, economic growth was 2 to 3 times what it is today. Corporate earnings were 2 to 3 times what they are today. So yes, valuations were very high, but they were much more justifiable. Expectations were good. The internet boom was just starting, technology boom. So yes, valuations were higher, but when you kind of ground valuations to the fundamentals, they were actually not as high as they are today.
So you're saying, there was actually real growth back then compared to now, whereas, the Fed's using fake nominal GDP, not accounting for real inflation rate, and they're manipulating a lot of the other statistics like jobs and GDP and in CPI, the inflation rate.
Yes. I mean, well, it's not even it's just there is very stagnant growth. I mean, even if you look at the numbers from the Fed, from the government, they're pointing to 1.5% to 2% economic growth versus 4 to 5. But keep in mind, in the late 90s, we had great productivity growth. That was an upsurge in productivity growth. Productivity growth is on a decline now and could likely be below, could actually turn into decline over the next year or two, as it's done in most of the developed nations.
Now, more about the stock market. I've heard other stock market prognosticators that are similarly bearish like you, also about the general stock market, say that a lot of the main reasons why the stock market is going up, besides central bank intervention with quantitative easing, I think they put over $1.5 trillion already in 2017, not the Federal Reserve, but the other global central banks in QE into asset prices, is that there's a ton of money coming in chasing up higher stock markets from passive investors and index funds, and that money is not being dispersed into all the stocks equally. It's mostly going into the FANG stocks, the Facebook, Amazon, Apple, Netflix, and Google.
That's fair. I mean, I think what's going on is there's a lot of investors, and there's different groups that are not price sensitive, that they're just buying. So you got passive investors that don't know what they're buying, that they're buying, like Campbell's Soup, for instance, they're buying at a price to earnings of 30, despite the fact that Campbell's Soup hasn't grown revenue in 15, 20 years. So you got that group. You got corporations buying back stock. They don't care what price they're buying it back at. You have pension funds that don't really have a choice. What are they going to do? Buy bonds that yield 2, 3%? They have to chase this market higher because their bogey is 7%, 7.5%. And if they don't hit their bogeys, they just fall further into shortfall. And then, like you said, we got the central banks. And it's not just the Federal Reserve. You have, here's the most egregious, the Swiss National Bank, which owns U.S. stocks and bought, they have what, like 80, I'm going to get this number wrong, but roughly 80 billion worth of U.S. stocks. They don't care what prices are. And you know what? If they lose money, they can just print more money.
Yeah.
And even like the European Central Bank buying European bonds, well, when they buy a European bond, that money is coming, some investor sold them that bond, and that investor is investing again, and some of that money makes its way to the United States. Keeping in mind that the United States is home to the most liquid capital markets in the world. The European markets, the Japanese markets, these other countries, they're not British, they're not nearly as liquid. So a lot of these investors, especially the institutional investors, the money eventually makes its way to the U.S. and it may come into the bond market, but it's the same theory that someone sold a bond and now they're going to move into a stock.
And, and those bond investments can be used as collateral for other, derivatives trades or other, stocks on margin. You can leverage those things up, and that's why you have hypothecation and rehypothecation. I want to add to your points though about the central bank's balance sheet. So the ECB with their QE program in the last couple of years, their balance sheet that they publicly admitted to, we don't know, with the currency swaps and all those, because the central banks don't allow independent audits. But the ECB's balance sheet, Michael, is now over the Federal Reserve. It's larger than the Federal Reserve. It's $4.5 trillion American. The Bank of England's balance sheet is now over $3 trillion American. The Bank of Japan's balance sheet is now over $4 trillion American. And we don't have an accurate number on what the People's Bank of China's balance sheet is. And that thing, I think China, there's a huge credit bubble in China since the 2008 financial crisis. They created more money and credit than pretty much anyone else when you subtract currency swaps in order to stimulate their economy. I think there's over 28 trillion RMB in credit floating around out there, and there's a lot of bad loans that are going to have to be written off or bailed out of some sort.
Right. So what was the European GDP? Do you know offhand?
No.
I know it's not that of the U.S. So now compare the numbers, or Japan, or even China. U.S. has the biggest GDP, the largest GDP in the world. So when you start comparing numbers, you also need to factor in how big the country is, which makes it even worse. And it's more egregious. So, yes, the Fed, you can make a case that the Fed has actually been the weakest or the lightest on QE. But QE is fungible. In other words, like the example we gave earlier, it has a way of traveling throughout the world's capital markets. And all these countries are executing QE the same way. They're buying financial assets. None of them are dropping money out of helicopters or buying bridges or giving it to little 8-year-old girls. So that's something to think about, because when the method behind QE changes, that's when things can get very, very interesting.
And these central bankers, Michael, they meet, I think, once a month at the minimum at the Bank of International Settlements in Basel, Switzerland, and they have conference calls. So I've interviewed Dr. Mark Faber many times over the years. He's adamant that this whole thing is coordinated. So for PR purposes, the Federal Reserve, after all those QE programs, they took a break and they passed the buck onto the other central banks to do the other asset purchases and to repair kind of some of their PR image.
Right. Yeah, there's no doubt in my mind that they talk all the time and they coordinate. It's been very clear the way that at certain times, especially during crisis, they're clearly communicating. But I think even now they're communicating. But that's also something to keep an eye on. If it starts seeming like they're not communicating well, they're battling each other, and you can see it through speeches and even possibly through actions. Again, that's a point where things could get ugly. So the financial markets are kind of balancing on this QE charade, whatever it is. But if it starts going away, whether it's the Fed taking away balance sheet or whether it's them battling or whether they decide to change the terms of QE, those are all signs to investors to watch out.
Yeah, and since these asset markets, especially real estate, stocks, and bonds, are supported in large part, you can make an argument that it's almost entirely by central banks. If they decide to take the punch bowl away, we could have really, really big corrections or crashes in these asset markets. But you mentioned about the lack of returns for pension funds, Michael. Do you think then, even with this central bank intervention, that there's big central pension fund crises that are coming down the line?
Oh, absolutely. The question, I guess, the only question to ask is when. They're virtually, so many pension funds are grossly underfunded. And the problem they have, which I touched on earlier, is that they are expected to make 7 to 8% a year. And when they don't, they're getting further in hock. So well, what does it take to make 7 or 8% a year? If you want to buy treasury bonds or relatively safe corporate bonds, that gets you maybe, if you're lucky, 3-4%. What do you then have to layer on to that? You have to take a lot of risk. You have to buy equities. You got to buy high yield.
Well, their problem is they have so much money. So if you're the state of California and you're CalPERS or CalFERS, you have hundreds of billions of dollars, if not more, to invest. So, for a little guy to make 7 or 8, it's a lot easier. You have more options. But if you're a big guy, you have to go into you want more liquidity. So for you to put as much capital into smaller markets and investment ideas, you can't really do that. I think what's happened, Michael, is they gambled. A lot of these pension funds put a lot of money into hedge funds, and the hedge funds, stole the money from them, with their fees. So which 2% net asset management, and then 20% of profits. So they gambled on those, and maybe they've done well on a few, but they've lost. And then the other thing is, a lot of the pension fund money also went into commercial real estate as the Federal Reserve was reflating with QE. And then Danielle DiMartino Booth has written articles about this, also saying that one of the unintended consequences of Dodd-Frank, trying to regulate the banks, was that they stopped the banks from doing as much trading on stocks and bonds and derivatives, but then the banks started putting tons and tons of capital then into commercial real estate loans, and those loans are starting to go bad too, and that the banks then sold a lot of those investments to the pension funds.
Right. I mean, there are so many different reasons on why it happened, but as valuations rise and rise, future returns get worse and worse. And keep that in the back of your mind, that you're kind of stealing, the markets are stealing returns from tomorrow. So as bad as the pension situation is today, consider the market's been rallying for 8 years.
And they're still underperforming by a lot. So if we have Harry Markopoulos talked about this in an interview on King World News over the weekend, that if the stock markets and bond markets and real estate were to crash, say 30 to 50%, the pension funds would be deeply in the hole after that. You mentioned the timing, though, of this. I remember, I don't know if you remember this, but Meredith Whitney was doing an interview tour. She had a book out. I Googled this a couple days ago. It's 2011. And the mainstream media just hammered her to the point where, I think she removed herself from social media. I don't think she'll do another interview because of how badly they embarrassed her, saying, she was Chicken Little. She had a lot of the stuff right. She was just obviously at least 6 years early on timing.
I think so. She was definitely early, but she probably also didn't realize that, like most people, how powerful QE could be on the financial markets. So it did a couple things. A, it allowed pensions to make more money than they probably should have, but B, it allowed municipals to keep issuing debt when they are, like Chicago, is clearly bankrupt. It's just forcing, again, this, our conversation, we've said this word 3 times now, the misallocation of capital. It's just creating different versions of misallocated capital all over the place. And I think she was dead on. It's just her timing, like most people's, is off.
Yeah, and that's the tricky thing, also with timing about trying to short all these bubbles when they do pop. Because I think the global economy and asset markets now, it's one giant minefield. But, for exact timing on this, if you were to, I don't think, saying it's going to happen in 2 months, I don't think you can do that. But I think, maybe in 2 to 3 years, I think there's high probability of this. But if you were to hold a gun to my head and ask me, for my best prediction, I don't think I could tell you if it's going to be 2 months or 6 months. Tell me when the Federal Reserve is going to actually reduce their balance sheet, or the other central banks are going to stop QE then.
It's a never-ending trap. Then none of them are going to stop. They may slow down, they may reverse, but the pain is just too powerful to stop them, and no one wants to deal with the pain.
Now, I think they care about the bond market probably more than any other market, especially for, government bonds. We've seen already Italy change the rules on 90-day commercial paper. Those guys were supposed to get their money back. They were the rules were changed on them, and they were forced to go into Italian bonds at much longer duration. So what's your opinion then on what's happening with the bond market now? Do you think the bond market's in a bear market, or do you think if there's another financial crisis that the dollar is going to get stronger and there's going to be a temporary reprieve and a lot of money is going to go into treasuries?
So I think bonds are, I've actually run some models on this, and bonds are somewhat fairly valued. And I know you're going to laugh, because bonds are yielding such low rates. But when you factor in economic growth, inflation, and where those are expected to be over the next 5-10 years, you get to like a 10-year rate of about 4 to 4.5%. Now, clearly, we're like 2.25, somewhere in there. So yes, you can say bonds are very overpriced, but then you factor in the Fed and a 1% Fed funds rate and a $4.5 trillion balance sheet. And when you factor that in, you come up with a value of about 2.5% for a 10-year bond, which tells me that bonds may be a little rich, but not overvalued. So when you start thinking about where bonds are going, it's a tug of war. I think economic-wise, inflation-wise, will all push bond yields lower. The economy isn't growing anytime soon. I think inflation turns to deflation. But the question is, what's the Fed going to do? And if the Fed decides to lower rates, do more QE, that also pushes in that direction. But if they really decide to start taking away QE, that tugs the other way. So I think it's important to understand what bonds are worth giving the economy, given what we think of the economy going forward. But again, you have to have a good understanding of what the Fed is doing, why they're doing it, and what they may do in the future.
And for listeners who are beginners, can you explain what an inverted yield curve is and what it might signal if it does happen?
Yeah, so a yield curve is basically the yield of different maturity securities. So everyone looks at the Treasury yield curve. So that what it basically says is the 2-year yields I'm just making up numbers here. The 2-year yields 1%, the 5-year yields 2%, the 10-year yields 3%, and the 30-year yields 4%. That's a normal shaped curve where investors are paid for taking on the risk of investing longer. But the curve fluctuates all the time, and what's going on now is that the longer term maturities, 10-year and 30 years, are dropping, and at the same time the short maturities like the 2-year, 3-year are rising. Now they're rising because the Fed's raising rates, but at the same time bond traders, those in the longer sectors, understand that as the Fed raises rates, they're hurting growth. So if you're buying a 10-year bond, you don't care about the next 6 months. You're focused on 10 years, and the Fed is harming growth. So they're pushing yields down, and we're still quite a ways from inversion, but we're certainly on the track to an inverted curve, which has always led to recession.
Yeah, I was going to bring that up, that normally in the past, I think like an inverted yield curve, the last 7 recessions, there's been a precursor signal of an inverted yield curve before a recession or depression.
Right. Exactly. But we're not there yet. And if the Fed starts talking about normalizing their balance sheet, reducing QE, the long end probably gets hit on that, because the Fed did something called Operation Twist, where they basically sold to the market their short-term securities, their 2-year, 3-year, 5-year, or 2- and 3-year type bonds, and they bought 5, 10, and longer bonds. So the Fed's balance sheet does have shorter bonds on it, but it also has a lot of longer bonds. So the Fed could, and this is also why the Fed wants to normalize their balance sheet. They want a steeper yield curve, and they don't necessarily want it for economic reasons. They want it to help the banks out, to make the banks more profitable, because at the end of the day, the Federal Reserve works for the U.S. banks. They don't work for the economy. They don't work for the president. They don't work for Congress. They don't work for anyone else but the banks. So, your listeners should always keep that in the back of your mind. And if you need any proof of that, just go back and look at who got saved in 2008 and who didn't.
I got a couple more questions before I let you go today. Now that Trump's been in office for a number of months since his inauguration in January, has he actually done anything you like so far?
I don't think he's done anything really. He's talked a big game, but this whole Russia thing has held him up. I think the Republicans are struggling to jump along with him on various things. Healthcare wasn't really thought out too well. It passed the House, but it may pass the Senate, may not, but it doesn't seem like a big change from Obamacare. Have yet to see anything on tax reform or trade or any of those things. So, at this point, you can't even give him a report card. He hasn't done much.
Those are interesting points of view. Yeah, I mean, he fired James Comey, and he stopped TPP. So he's done, and he put in a pro-Constitution Supreme Court judge. So there's a few things that he's done so far that I did want him to do that I liked. But yeah, I don't like a lot of the stuff. But I also don't think it's all his fault. I think he inherited an absolute mess from Obama and from other previous regimes with the debt and all the other disasters in D.C. he inherited. And, there's the Republicans in Congress, Democrats and Republicans in Congress. Surprisingly, his own party, the Republicans, although he's not a real Republican, he's an independent who just ran on the Republican ticket and took advantage of that. But, I think they're sabotaging, Michael, a lot of his domestic agenda with the healthcare plan and also with the tax cuts. So I think, the Republicans aren't behind a lot of the stuff he wants to do.
Well, I think, Obama ran into this too, right? And even Bush to some degree, but Obama really ran into it, that Congress does not want to help each other. They're very partisan. They're on their own sides of the aisle. And Trump's just getting a lot of what Obama had to deal with too, that the Democrats will not vote for anything Trump does. So Trump has to get virtually every single Republican to agree, which is very hard to do. We saw this with Obama's Supreme Court pick. That never happened, right? And a lot of things. So, I think one of the big problems that every president or that each president has faced, and they hopefully will not have to face going forward, but it certainly seems like it is a divided Congress.
Well, I think, as things have gone on really since World War II, I think Congress has become increasingly, they've delegated so much power to the president with executive orders, and then Congress in general just doesn't want to make a lot of important decisions. They just want to delay it. I think they spend so much of their time in Congress, Michael, trying to raise money for re-election that they don't really care about the American people and trying to put in quality legislation. Heck, two of the last important major bills, the Patriot Act and Obamacare, a lot of people in Congress admitted to not even reading the bills before they were signed. It's
right.
Really gotten ridiculous at this point. I mean, Congress, I think the approval rating of Congress it just keeps going down and down. I don't even think it's at 20% for the approval rating of Congress. But I got a couple more questions for you before I let you go. We're a little over 40 minutes. Are there any undervalued industries you like? Because we talked about how overvalued a lot of the asset classes are. Is there any sectors or industries that you think are interesting value propositions right now?
Industries, no. There's certainly, a few little smaller cap type stocks, one-off plays. The gold miners, if you certainly hunt around there, you can find guys that are priced either at or below book value. But there's not much out there. I tend to be a little more focused these days on first of all, I have a very conservative portfolio, but some of the risk that I am taking is in what I would call yieldier equity type plays. So there's some agency REITs, which they've gotten expensive too recently. Some closed-end municipal funds, some preferred stocks, but they're certainly not without their risk, and it's certainly not a big portion of my portfolio, but it's just I'm struggling, and I know some guys that are small cap managers, value managers, and one of the guys has just left the business because he couldn't invest any money, and the other guys they're struggling with what to do with all the cash that they're sitting on.
Yeah, that's very interesting. From a lot of the articles I've read and money managers I've talked to in my contacts list who aren't, libertarian or Austrian school, who are just, more value investor guys, a lot of them are going to cash right now. They're selling the stocks that they made money off of since the reflation by the central banks the last 5 or 6 years. And then they're starting to go heavily net short certain things. So they're looking at things that are consumer discretionary, that are tied to malls, like REIT malls, things like that. So they're starting to go heavily short retail and restaurants and home builders and other things like that.
Right. I mean, there's definitely a lot of grossly overpriced sectors and certainly individual companies.
Lastly, before I let you go, I want to get your opinion on gold right here. I would have thought that gold would be a lot higher by now, yet it's struggling to stay above $1,250. So, do you think then that gold's in the next year or two is going to be a lot higher? Or do you think it's going to stay flat or lower?
I see no reason not to own gold, and my answer is yes, I see it higher. But I would have answered the same question. I would have answered that same question the same way 2 years ago. When the value of gold is discovered by more of the mainstream, it'll take off, and it'll probably take off in a very hyper manner.
Like
but
Bitcoin and the
yeah,
other altcoins?
yeah, exactly like that. But in the meantime, it's going to go up. It's going to go down. I kind of have my core gold position, and I'm very happy with it. And if it drops another 100 points, 200 points, so be it. Maybe I'll buy a little more. And if it goes up a couple hundred, that's great. But I'm not selling it. So I just think it's that thing that you have to think of as insurance. Just like my insurance policy, I don't ever look at it, but I know it's there in case it hits the fan. So I think the need to own gold is much stronger today than it was in the past. But that doesn't mean everyone sees value the way I see value, clearly.
Yeah, a lot of people don't believe in owning gold. It's not taught for most mainstream investors. A lot of retail clients. The sentiment levels for a lot of people who have owned gold, silver, and mining shares are extremely bearish. I think a lot of people who are loyal listeners to my podcast, they actually admitted to me, Michael, that they've been selling their gold, silver miners and chasing Bitcoin and Ethereum and, going all in on all these different coins because some of them were going up, some of them were doubling every couple weeks.
Right. I mean, it's another. I'm not a big. Be honest. I haven't done a lot of homework on Bitcoin or any of these other crypto coins, currencies. But they just look like pyramid schemes, like tulip bubbles. Now, maybe one of them, two of them will succeed, but there's so many of them, and trying to figure out which is going to be the one, I think, is a dangerous bet. But there is a lot of money to be made trading, and a lot of money to be lost trading in those. I'm not. I was going to say securities, but they're not securities in those assets, I guess.
Yeah, they're not securities, and there's actually not rules and regulations yet that the SEC has for coins and tokens and digital assets yet. So there's not specific separate laws for them yet. There's only general fraud. So they're not technically securities, but for some of these initial coin offerings and some of the ridiculous promises that are made on the websites for some of these ICOs and tokens, some of the CEOs of these companies are going to go to prison in a few years for fraud when their tokens or coins crash to zero. Because some of the promises are just ridiculous. But yeah, I think if the gold does go down, the paper price of gold smashed. I mean, now it's well documented that gold and silver are extremely manipulated. I even have a source that heard the former CFTC commissioner Gary Gensler admit it. They were both manipulated, but said the CFTC can't do anything about it. They don't have the money and power and resources to stop it. And then, of course, he went to Hillary Clinton's presidential campaign to go be her campaign finance manager. But, if gold does go $200 lower, I think it's time to back up the truck because then I don't think the miners then are going to be able to survive. So there's going to be supply problems for gold and silver. We're already starting to see evidence that there's some supply problems for gold and silver. I know you look at the royalty and streaming companies. The CEO of Franco-Nevada said basically there's no growth for the gold mining industry at the current price, and they're not making investments in any gold mining, new gold mines coming online. So that's how the lack of potential new supply in the future without higher prices.
And China's not letting any of their gold out of the country. So whatever growth is coming out of China, it's not going to be into the market.
Exactly. So there's strong demand for physical gold outside the United States, and from very high net worth people in the U.S. are buying it. But the retail person for gold, silver, and mining shares, they're pretty much mentally they're checking out. There's very few people out of the people that were there starting after the 2008 financial crash that are still accumulating gold, silver, and mining shares. The percentage is down a lot. sentiment's extremely bearish. Just like sentiment for Bitcoin and Ethereum and all the other altcoins is extremely bullish still.
Right.
Well, Michael, I really enjoyed our discussion today. If our listeners want to find out more of your work, how did they do so? And tell our listeners more about your newsletter.
So you can find us, first of all, at www.720global.com, 720global. We recently started publishing The Unseen. And The Unseen discusses markets, economics, usually from a more broader macro type scale, some investment psychology, behavioral sciences, and it provides investors with a broad base of knowledge. And we call it The Unseen from Frederick Bastiat, who said there's the seen and the unseen to every event. And everyone, in our opinion, is focused on the seen. What's good? The Fed's printing money. That's good because of this, that, and the other. Well, there's also the unseen and the opposite effect. And that's true with everything in life, not just markets and economics. But that's what we try to expose in the unseen.
Yeah, I'm not sure if you read Henry Hazlitt's Economics in One Lesson, but a lot of his writing, it's my favorite economics book. It's a great beginner's book to give to someone as a gift, and he explains free market Austrian school economics very simply, but a lot of his writing in that is actually based on Bastiat's writing from over 100 years before Hazlitt.
Exactly. I mean, that it is a great book, and Hazlitt kind of goes through examples. I mean, the book is full of examples of the seen and the unseen.
Yeah, Bastiat was just an amazing, Bastiat should be one of the most famous people in France, and yet, a lot of French people I've spoken to have never heard of him because, he's pro-liberty, pro-freedom. He was a libertarian before. He was, small government type, and, that they don't teach any of his writing in France. It's just really sad.
Right. Well, yeah, I mean, economics in general is poorly taught. Whether you believe in one school of thought or another, it seems like they primarily just teach Keynesianism, and they, it'd be like taking a class on religion, but only learning about one religion. They should teach, whether the professor thinks that they're valid or not, they should teach all the different schools and let the students explore each of them and decide what's good and bad about all of them, each of them. But unfortunately, that's not how economics is taught.
Agreed. That's how it should be. But then you can't feed people propaganda and give them fake news and get them to agree with stuff without, without challenging them in arguments and challenging the professor. And they don't really want a lot of independent thinkers nowadays.
Oh, exactly. And, the Federal Reserve, they're the worst of it. They're just feeding the public a bunch of BS. I'm actually writing an article now on price stability. The Fed is doing anything but price stability, considering the purchasing power of the dollar. But they sell it as price stability.
Yeah, well, they have a manipulated CPI that says there's no inflation, but my rent, my food, healthcare, electricity, education costs, all these things are going up like crazy over the years.
Right. Everyone's standard of living is decreasing except for the very wealthy.
Well, I want to thank you again for your time, Michael. I always enjoy your discussions, and I enjoy your friendship in real life. So you're actually a friend in real life. So it's nice to actually meet people I have the discussions with on the podcast in real life and sit down and talk more.
Absolutely, and we're due for a lunch, so let's try to get that on the calendar as well, and we'll talk soon.
My pleasure. Take care, buddy.
Thank you. Bye.
Wall Street for Main Street needs your help. YouTube stole $7,200 from Wall Street for Main Street in annualized YouTube AdWords revenues, and they kneecapped our analytics down by more than 80% across the board since September 2016 with their new censorship algorithms to stop the rapid growth of our channel. That was money we could have used to upgrade our website, pay bills, and invest in improving our content and growing our business. Our audience of loyal listeners is all over the globe and so large now that if most or all of our listeners were to commit to donating $1 to $5 each month to our Patreon account, we could easily meet our goal on Patreon. Wall Street for Main Street also accepts one-time donations on our main wallstreetformainstreet.com website. That's WALLSTFORMAINST.com website via PayPal, Gold Money, or Bitcoin. We also accept donations of physical precious metals that can be mailed to us. Thanks to all listeners who have already made a donation, and thanks in advance to any listeners who make a future donation or contribution to the growth, improvement, and success of Wall Street for Main Street.